So rule number one, it's your money or yours and an underlying investor. So you need to trust but verify everything. And actually, I would say verify and then trust these days. You know, it's you want to trust people, but until you've worked with them for a while, definitely verify everything the borrower tells you before you trust. 6 due diligence areas when you're vetting these deals. You're going to look at the borrower. We've talked about this, the borrower's income, the location of the collateral, the value of the collateral, the market conditions. If you had to take that house back, what are your exit strategies? If you had to foreclose, what would it cost to foreclose? Could you sell the house, rent the house, turn it into an Airbnb, flip it to another investor for a slight fee over and above what you're owed, or just to get your money back? You know, what could you do? What's your exit strategy? Rule number 2, sadly, borrowers often can be overly optimistic. And even if they believe the story themselves, it's not always the accurate story. They will tell you what you want to hear to get the deal done. Not every borrower. There's some great people who are super transparent, but it's the nature of the beast. People want to believe this deal is going to work out. It's going to work out great for everybody. And so they'll tell you what you want to hear. They'll probably tell you what they want to hear. And so you need to ask for proof of some of these things. Have the borrower show you that they have the ability to repay. If this is a 6-month loan, how are they going to pay you those interest payments every month before this deal closes? Do they have a line of credit? Do they have other properties that are cash flowing? You know, how can they pay you back? What is their experience? We talked about that. What resources do they have in place? Do they have a team of contractors? Do they have a bank they work with to refinance properties if they're planning on, you know, keeping it as a rental? What do they need to do the deal successfully? What's up with the supply chain these days? Can they get the materials they need at the price at which they believe they can, right? Make sure those things are thought about. Always protect your capital. And if you're using somebody else's money, for goodness sakes, always protect their money. This is your reputation, your integrity. If you are investing somebody else's money and trying to make, you know, help them, then make sure you protect their capital above everything else. Then you protect your capital. And if that borrower does not have the ability to repay, then your capital and other people's capital is at risk. So you have flexibility. When you evaluate, you can look at all sources of income. You know, banks sometimes can't look at all sources of income, but we can as private lenders. And you should, you know, look at all their sources of income. If they're self-employed, you need to understand where their cash flow comes from. Rule number 4, location, location, location. You need to know exactly where this property is located. You guys all know this. The location of a property influences the selling price, how quickly it sells, what type of buyer you might be getting in terms of their ability to qualify. You know, you have to look at all these things. And I think I said here, 100 feet can mean the difference between a $100,000 house or $1 million house. You know, I don't know if you guys have been in neighborhoods where it's like that. You literally a half a block can make a difference in the value of a piece of property. When buyers are looking at houses to buy, so this flipper's getting ready to sell, what are their buyers looking at? They want to look at school district, access to transportation, churches, grocery stores. What's the crime rate? How walkable is the neighborhood? All these things. So look at the location carefully. The borrower must know the collateral. We talked about that. That's important. The borrower, if they're rehabbing it, they need to be able to tell you what their budget is and their scope of work. And here I think it behooves you to have some knowledge in costs of construction. You know, take a contractor out to lunch, pay for their time to figure out what is the average cost to rehab a kitchen from ground up? What's the average cost to rehab a bathroom? Start creating these rules of thumb for rehab costs. And so when they tell you what a budget is and they give you a scope of work, do their numbers match up to their scope of work? Are they telling you this house needs a brand new roof and a full HVAC system and all new hardwood flooring and their rehab budget is $10,000? Well, that doesn't make any sense, right? If they're telling you they just need to put lipstick on a pig and repaint some walls and a couple of little rooms of carpet, but their rehab budget is $50,000, that doesn't make sense either. So know their scope of work and find out if you think their budget matches. Rule number 6, the market, not the property, drives the price. You guys know this, you're real estate investors. Markets are dynamic. You want to look at the market in 90-day windows. Markets don't change in a week in real estate, but look quarterly. Look at those 90-day windows. Is this a buyer's market, a seller's market? Look at the demographics in these markets. Know when your flipper is going to sell to an end buyer, who are their potential lenders? What are the timeframes for turning around those types of loans? How many buyers will qualify for those types of loans? The more you can educate yourself about this stuff, the safer you're going to be as a lender, because you can evaluate the deal better.